What is liquidity? Simply put, it's a measure of how much cash is available to pay off debts. In this video post, we will explain the term in great detail and what it means for your business and personal self. It is a term that is used frequently, so let's give you a solid understanding. Liquidity may have various connotations depending on the situation, but it always revolves around one thing: cash or money that is ready and waiting to be spent. Liquidity is a term used to describe the ease with which funds may be obtained. It refers to the amount of money accessible on demand and how quickly a financial asset or security can be converted into cash without losing significant value. In other words, how long it takes to sell an item. Liquidity is crucial for this metric because it demonstrates a company's flexibility in fulfilling financial obligations and unforeseen expenditures. It also applies to the general public. Their financial situation improves if their liquid assets, cash savings, and investment portfolio are greater than their debts. What are the types of liquidity? Market liquidity and accounting liquidity are two forms of liquidity that exist in the financial world. Market liquidity refers to assets and investments, whereas accounting liquidity refers to a business or personal finances. Market liquidity and accounting liquidity are two words that refer to two different things. Market liquidity is defined as stocks' ease of trading in the public markets, whereas accounting liquidity refers to a firm's capacity to meet short-term obligations. If you can acquire or sell an asset rapidly without affecting its price, it is considered liquid. A high liquid commodity can be sold for its entire value quickly. An asset that needs a long time to sell, or one that may only be sold at a reduced price, is classified as less liquid or illiquid. Stocks with both types of liquidity can be viable options for you as an investor. However, market liquidity is typically what is meant when investors talk about liquidity. What is market liquidity? The liquidity of an asset is measured by its market volume, which measures how readily it can be converted into cash. In other words, how marketable it is at constant and transparent pricing. A high level of market liquidity implies that there is a lot of supply, but also a lot of demand for an asset, and that it will always be available to sellers. It's impossible to call something liquid if no one wants to sell it, but no one can purchase it. Liquidity is not the same as profitability. The shares of a publicly traded business, for example, are liquid. They may be sold on the market very quickly, even if their value has decreased. Someone will always purchase them. Investors must think about liquidity of a particular asset or security while investing. The most liquid assets are savings accounts and money market savings accounts are both sorts of savings accounts. Stocks traded on major exchanges and exchange-traded funds are included. Government bonds, bank and non-bank commercial paper, other securities that you can withdraw from at any time and invest in other short-term money-making instruments. Intangible assets, such as real estate and fine art, are examples of illiquid assets. They also include securities that trade on foreign stock exchanges or penny stocks which trade privately. Shares are liquid assets. Liquidity is defined as the ease with which a stock may be bought or sold. Many segments of the stock market, such as the large cap sector, are said to be highly liquid. This is due to a variety of reasons, including trading volumes are high, bid-ask spreads are not very wide, fast trades can be executed. A stock's liquidity. You need to look at the amounts of money the stock is worth. You also need to look at how many shares are available. What is the bid-ask spread and how big is it? What is the normal trading volume? The bid-ask spread for a stock like Starbucks, which is an excellent example, is currently a penny, $112.36 to $112.44 as of this writing. This shows that the stock is very liquid, and even trade of modest size does not have an impact on the price. A stock's liquidity is judged by the amount of trading activity it sees each day. The fact that Starbucks' typical trading volume has been under 6.5 million in recent months is another indicator that the market for its shares is liquid. Unless you're trading a significant number of shares, thousands, you may consider Starbucks stock to be liquid. Make sure you subscribe and turn on notifications so you don't miss the second video on what is liquidity.